So the big question is this: how do investors like us who trade options and manage our own money generate income regardless of where the stock market goes, and do it all in a way that lets us make time for the people and things we love, and yet still build wealth and remain profitable? That's the question, and this podcast will give you the answer. I'm your host, Kirk Duplessis, and you're listening to The Daily Call from Option Alpha. Hey everyone, this is Kirk here again from Option Alpha, and welcome back to The Daily Call. Today we're going to be talking about the best way to use protective put options. And the best way to use protective put options is actually not to use them at all. So how about that? That's actually a little bit of a reversal from the title. But look, the reality is that when we go back through and backtest put buying strategies, and specifically like single long put buying strategies, there is no put buying strategy that actually is better than just not using a put buying strategy. So yes, there's probably certain time periods during a market crash where using protective put options works for a very small zoomed in time of reference. But the problem with that is that we never actually go through a market situation where you know exactly when you need to use that put protection buying strategy and when not to use it. So the one microscopic time that a put buying strategy would actually work and help the portfolio is almost impossible to pinpoint and to time as an actual trader going through real market scenarios. So when we actually went back and said, okay, like backtesting wise, let's assume that we knew when the top was going to be in the US equity markets in 2007, 2008. We knew that exact top was going to be there. Great. At that time, start executing different put buying strategies. And we put this all on the weekly podcast so you can search for it and go back and listen to the research. But the end result is that even though we knew or told the system we knew when the top was in and to start buying puts right before the market crashed, we actually still were left with a strategy that was less productive, less efficient, made less money than actually just holding through the market crash and not buying protective puts. So again, what we see here is that buying options on a continuous basis is not a good strategy for success. In fact, it actually leads to lower performance and returns than doing nothing at all. So here is one alternative to doing it. So I promise I won't leave you hanging and just say don't do anything at all, right? So the alternative here is to use a collar. And so a collar strategy is where you would sell a call option to finance most, if not all, of the put option that you purchased. Now, this is a good strategy to use because if you can do this for no cost or even a little credit, it does not create a draw or a drawdown on your portfolio and cash balance. And so it doesn't offer as much protection as a flat out regular long put option, but you can slowly start to chisel away or hedge your portfolio on the way down by using collars, and it could be costless in many cases. So hopefully this helps out. As always, if you have any questions, let me know. And until next time, happy trading. Thanks for joining us on The Daily Call. Be sure to subscribe right now for more daily options trading ideas, strategies, and tactics to help you learn how to place smarter, more profitable trades. And if you like what we're doing, don't forget to give us a rating and a review so we can continue to bring you the best daily content possible. We'll see you again tomorrow, right here on The Daily Call from OptionAlpha.com.